Hey guys, I know you're probably thinking, does she ever change clothes or take a shower? Yes, I do, I promise. But I thought for a moment that maybe the smartest thing for me to do is make all these lessons at once. So that way I'm just getting them all out of the way and I'm on the same train of thought throughout the whole thing, so I'm not jumbled and all over the place as much as I would be if I was doing this across several different weeks. So this lesson is for Chapter 11-3, and it's accounting for the declaration and payment of a dividend. Dividend is a new word, but I know for sure everybody loves the word dividend because it means money. And everybody loves money. So, in part one, like last semester, you guys learned that a sole proprietor, or a person that was the sole owner of a business, they could withdraw cash from the company by withdrawing money from their drawing account. Well, now this semester we're working with a corporation which has tons and tons of owners. So how do they get their money, those owners? Well, they do it through dividends, and that's what we're going to learn about today. So I'm on page 332 in your book, and I'm just going to read through this because this is important stuff and I don't want to miss anything. It says the owner's equity accounts for a corporation are listed under a major chart of accounts division titled Stockholders' Equity, and that's what you see up there on the board. There's Stockholders' Equity section of the chart of accounts. Most corporations have many stockholders. It is not practical to have a separate account for each owner in the business. Instead, a single owner's equity account titled Capital Stock is used for the investment of all owners. So that top account there, the 3110, that is a account that the investors use for the investment of all the owners. Net income, or when a business earns money, increases the corporation's total stockholders' equity. Some income may be retained or held on to by a corporation for business expansion. An amount earned by a corporation and not yet distributed to stockholders, I'll pull that up here for you. An amount earned by a corporation and not yet distributed to their stockholders is called retained earnings. So retained earnings is the stockholders' equity account used to record the corporation's earnings. Some of a corporation's income may be given to stockholders as a return on their investments. Earnings distributed to stockholders are called dividends. So not all the money that a business earns goes straight to dividends to the stockholders. Only a portion of it does. Okay, and those are the dividends. The part that the corporation holds on to, that's the retained earnings. A corporation's dividend account is a temporary account similar to proprietorship's drawing account. Each time a dividend is declared, the account called dividends is debited. So dividends, normal balance, debit. At the end of each fiscal period, the balance in dividends is closed to retained earnings. A group of persons elected by the stockholders to govern a corporation is called the board of directors. So the board of directors, they are in charge of governing the corporation. And if a business does want to declare dividends, they can only do that by formal action of the corporation's board of directors. So the board of directors has a lot of power. Action by a board of directors to distribute corporate earnings to stockholders is called declaring a dividend. They usually will declare them on one day and then actually pay them out on another day. Once a dividend is declared, they have to pay it. They don't really have a choice. The dividend is a liability that must be recorded in the corporation's accounts. So dividends are a liability in a way because it's money they're going to have to pay out. A dividend cannot exceed the balance of the retained earnings account. Why would that be true? Well, retained earnings is the money they're holding on to if they don't. Like if they wanted to declare a dividend higher than that, that would be probably illegal because you can't give people what you don't own. So, the business that we're working with, the Three Greens Board of Directors, they are going to declare dividends every quarter. So they're going to declare them on March 15th, June 15th, September 15th, and December 15th. It says the dividends will then be paid the 15th of the month following the declaring of the dividend. So you don't record it when it's finally paid out. You record it in your journal as soon as it's declared. Because when they declare it, they have to pay it. So here we have a sample transaction. It says December 15th, Three Greens Board of Directors declared a quarterly dividend of 5 cents per share, capital stock issued is 75,000 shares, and the total dividend equals $3,750. The date of payment is January 15th. Well, if they are declaring a dividend, they're going to debit the dividends account, and by declaring that, they now have a liability. And so they also have to credit their liability account for dividends, which is dividends payable. So here is what that would look like. You would debit dividends and you would credit dividends payable. That's a pretty simple concept. And again, this is for declaring the dividend, not paying the dividend. So what we'll see on this next slide is what to do when you pay a dividend. So I am on page 334. It says 3 Green issues one check for the amount of the total dividend to be paid. Most corporations make the check payable to an agent, such as a bank. So they just write one big check to a bank and pay from the bank to all those different people. The agent then handles the details of sending dividend checks to individual stockholders. When this entry is posted, dividends payable has a zero balance. Procedures for posting a cash payments journal were in Chapter 9. So, surprisingly, we are going to put this entry into the cash payments journal. And when we read the transaction, we'll understand why. So let's go ahead and do that. January 15th says they paid cash for quarterly dividend declared. Sorry, that's not right up there on the screen. It should say paid cash for quarterly dividend declared December 15th for $3,750. And you guys can see that in your book on 334. Okay, so if you, I didn't want to bring that up. That's okay though. If you paid cash for the quarterly dividend and you're picturing the cash payments journal, well, let's just say we're not even picturing the cash payments journal. You paid cash that you had previously incurred a liability on, okay, because it was dividends payable. Well, now you got to undo the dividends payable and you got to credit cash, right? So if you go put that into the cash payments journal, this is what it looks like. Here's the cash payments journal. You would first put the date, which here it says January 15th. You would put the account that is being debited, dividends payable. Your credit, remember, is the cash credit column. And I know it's been a while since we've used this journal, but cash credit, there's always going to be an entry there. Because cash payments journal, every one of them has a cash credit. So this box will be your debit, which is dividends payable. You put your check number, which is $742, and you put your debit amount, which is $37.50, and then your cash credit. So you've got your debit, you've got your credit. We good on that part? Sometimes students will ask, well, why do we put debit here? Well, that's because on that previous page, let me see if I can go back. Right here, dividends payable was credited. Well, if I go forward to do the opposite of that, we're going to debit dividends payable because now we're actually paying it out. So we don't have that payable anymore. Hopefully that makes sense. All right, so that takes care of this lesson. I'm going to make another video for the work together and the on your own, or work together, and then you guys will do the on your own and application problems by yourselves. Have a nice day.